Welcome, everyone, to our 2023 year in review. Marshall and I are here to recap 2023, give a look forward into 2024. There's a few things that are on our minds. We're going to give you a bit of a firm update to start. We'll dig into some data and some slides on the year in review, and then we'll touch on a few things that we think you need to be aware of for 2024. Marshall, you and I have a ton of stuff to go through, so I'm going to pass it over to you right away now and get us started with a bit of an update on North Road.
Thanks, Cary. What a year it's been. We've been working, really, really hard at transitioning a business from one firm to another. We were working with one custodian, National Bank, and moving over to a Viso, and the process was challenging, but we're through it, and it's great to be on the other side of things. Would you agree?
Yeah, happy to never have to do that ever again.
That's right. That is our running joke around the office. Never again, right? Great to have some new team members join us at North Road. First off, Ja Lu was one of the colleagues that we worked with at Pavilion for over 10 years. He's joined us as the Director of Investments. And Rob Patterson has joined us as Director of Operations. And then we've got Richard has joined us as an associate in the investment management team, and it's been even great having Olivia have join us on the administration side for a number of months, helping us get all the information built up into our system.
Yeah, it's been great to see a few new faces for sure, Marshall. And it's always a challenge with every business for our folks who've built businesses to find the right folks and get them in the right chairs. But I'm really excited for this year and these new folks who've joined us. You and I just couldn't do this without them. Let's be honest, right?
Yeah, absolutely. So we are now in the process of getting the Q4 2023 statements out, and we expect those to be delivered pretty soon. We're recording this on the 20th of January, so between 3 and 4 weeks it takes us to turn around a statement, and we expect to see that very soon. Right after that, we're going to be working on tax reporting, and this year is going to be different than years in the future in that we are going to have to combine tax reports from two firms. But we will do the work, and it'll be available here at the end of the Q1 and going into Q2 periods. We've also could talk a little bit about some of the changes that we've seen in some of the tax rules and some of the registered account rules. One being the introduction of the first home buyer savings account, and we've been busy opening up those accounts for some of our younger clients. And we're seeing clients that are able to save up to $8,000 a year, add money to this account. And so we're happy to kind of explain what the account is to anybody that needs to know more, and we're happy to do that. The other thing is the increase to the tax-free savings account rules. So we are now able to add $7,000 to tax-free savings accounts into 2024. And it's been a busy few weeks adding, many thousands of dollars across all of our clients' accounts into those tax-free savings accounts.
I think, Marshall, one of the things I wanted to highlight in particular for our folks who are still working and need RSP contributions, the deadline is still first 60 days, but this is a leap year. So it's February 29th, not March 1st when it usually is. So another reminder for folks, don't leave this to the last minute. Get this done at the beginning of February. We don't want to be scrambling if there's any issues or if folks have questions. So RSP deadlines are around the corner. Contact us if we haven't reached out to you already. And if you need some tax help around RSPs, let us know.
Yeah, absolutely. Another update is the introduction of our client portal. And everybody will have received an invitation to the portal, and it is critical that all of our clients log in and have access to that, not only for the quarterly statements that we're going to be delivering, but for tax reporting. If you do not have that invitation, just please get in touch with us, and we will be inviting you back into that portal to get you the access.
Marshall, maybe just a reminder that folks, when they first came on board, received an invitation from Aviso Credential, the custodian, as well as from ourselves through our software provider, Digit. And it's the Digit portal that we're talking about, the client app and portal.
That's
Credential, Aviso, of course, is available, but our quarterly statements will be uploaded to the client portal, the Digit portal.
Yeah, absolutely. And I've been using the app on my smartphone to get access to it, and it works really, really well. And we've had a number of clients say they appreciate it as well. So if there's questions, reach out and we will get it all organized and set up for you.
Yeah. Marshall, let me touch on a couple of quick things. Still another around taxes and reporting. There are new trust reporting rules coming in for 2024. And the real key flags, the things I want clients to remember or think about is, do I have a joint account with someone in another generation or outside of my spouse? So with my kids or grandkids. Do I have an in trust for account and an informal trust for grandkids or kids? Am I on title with my kid's house? Maybe I help them buy a house. These are all flags under the new trust reporting rules that some form of reporting needs to be done to CRA. So we're not accountants. We're not giving tax advice, obviously, but just a heads up for folks as tax reporting comes around the corner, they need to ask accountants about these accounts and get some feedback as to whether or not they fall under these new reporting rules under what's called a BARE trust, BARE trust.
Yeah, good advice. And a couple updates on, there's been some changes in the Canada Pension Plan, some increases in contributions from employers and employees. Just something to highlight today. We won't get into the details, but there is some changes to that program to expand future benefits, as well as the dental benefit is coming into Canada. Do you want to just say a couple words on that program, Cary?
Yeah, I think very similar to the First Home Savings Account, these are new programs, so I think everyone's getting used to what the key details are. But my understanding is that if you're a senior over age 65, this really needs to be on your radar. So the couple of key things is that it's rolling out in a sort of staggered fashion. So seniors are coming out over age 70. You're supposed to be receiving a letter in May to let you know about that. March, I believe it is. Sorry. And then in May, 65 to 69-year-olds are able to apply online. That's the plan right now. So if you have a household income less than 90,000, that's the cutoff. So there are folks potentially, Marshall, that depending on how they're drawing income off of investments, that may fit into that group. And I had a question on why 90,000 is the cutoff. And you and I, at some point, we should do a webinar on the stats and details around income that we've collected over the years for Canadians. But 90,000 is about the median household income in Canada. So it's not a perfect number, but it's pretty close. And I think that's probably why that decision was made, was this dental benefit is there to help folks who are sort of below median income in their household.
Yeah, very good. All right, let's jump into the 2023 review slides.
Okay. So Marshall, I think let's start by running through returns for the past year. So let's start with the Canadian market returns. There we go. Overall, good year for equity markets. It didn't feel like it until the very end, I think, for lots of folks, Marshall. We're going to touch on 2023, and then we're going to step back and look at 2022, 2023 combined and give folks a little bit of a bigger window. We're always talking about focusing on long-term returns more than 10 years. But I think looking at these last 2 years is really key, because for the first time in a long time in 2022, we had real concerns about inflation and a dramatic increase in interest rates. And so we really haven't seen this in, you could argue, in almost 40 years, right, Marshall? So I think that's a real key thing we need to wrap into this and give the longer term perspective. But last year, Canadian market, large outperformed small companies. Small value outperformed large value, and then large growth dramatically outperforming small growth. So just to highlight there for folks as to what happened within the market. Overall, good returns in Canada. U.S. market returns, quite a big variance compared to the Canadian side. U.S. tech was really the place to be, and we're going to touch on this, in particular the 7 large tech firms called the Magnificent Seven this year because they provided most of the return in the U.S. But you can see large really outperformed small, and growth really outperformed value, both on in particular on the large versus small side. Value still nice returns. We have a focus on value in our firm and on smaller companies, and returns were nice, but comparatively speaking, those large tech firms really carried the load. And then outside of Canada and the U.S., slightly different here. Large really was the winner outside of Canada and the U.S. Although again, returns in the alternative were still nice. Large value companies being the key thing to hold last year. Not predictive of the future, but nice to see where things came in. Marshall, do you want to touch on what we call premiums in factors? So these key characteristics within markets, how often they outperform or underperform?
Yeah, for sure. So we believe that taking intelligent risks is really, really important. And we want to look to historical returns of different components of the markets and even just the market in general to find out how often are we rewarded for taking the risks of either being in the market, owning smaller companies and compared to larger companies, owning value-based companies instead of owning growth companies, and having exposure to businesses that have a profitability factor. So when we look through the different 1 and 5 year, 10-year periods that this chart represents, we can see that first looking at the market, not every year are we rewarded for being in the market. Over 1 year periods, we're seeing that 70% of the time we are rewarded, 30% of the time we're not. And thankfully, it gets better as time goes, is measured over longer periods. And that same relationship happens across all of these factors: size, value, and profitability. So when we're pulling in portfolios, we want to know that our clients have a time frame that we can let these factors actually be expressed and hopefully come into the portfolio. But in any 1 year, we know that we cannot expect 100% success in how these premiums are coming to us as investors.
Great. Let's talk about the extreme here, Marshall, because it really was a year of just phenomenal variance. So what we're seeing on the screen right now is the top kind of pink line, what's been termed this year the Magnificent Seven, 7 large tech companies. And the thing I think that connects all of these, Marshall, is really that AI came to the forefront early in the year with ChatGPT, and this just massive movement in how folks are working and the tech tools that are being used. And each of these companies has some form of connection to AI, whether that's Microsoft with a direct relationship to ChatGPT, or Alphabet, Google, Amazon, Meta, Facebook. Each of these, NVIDIA with the backend infrastructure, each of these has a connection to AI. And we can see just what happened as a result of that. You see early in 2023, this spike as ChatGPT really took off, and the excitement around AI took off, and then it just was no holds barred after that. The Magnificent Seven providing about 75% and making up the vast majority of returns in the S&P 500. Down at the bottom are the 493 other companies in the S&P 500, and you can see for the year, reasonable return for a year there, but nowhere near the outcome that happened if you only owned those 7 companies. Anything you want to add to that, Marshall?
Yeah, I would say that last year isn't going to be prescriptive of what will happen in the next year or the next few years. So I think when we kind of zoom out and look at the returns from 2022 and 2023, it can really tell a different story.
Yeah, that's for sure. So let's do that. On this chart here, we are showing the Russell 1000 Technology Index and the Russell 1000 Value Index. So many more companies than those 7 in each of these, but a focus of comparing technology versus value. Marshall, how would you describe value for folks? We talk about this a lot. Most of our clients would know this, but really quickly, what would the value factor look like if we were trying to compare it versus, say, tech growth or technology?
Yeah, I would say it would be businesses that have lower stock prices in comparison to other firms in the marketplace, like in this case in the United States. So in 2022 and 2023, it would, or especially in 2023, it would not be technology firms. They would not be categorized in as a value investment.
Right. So when we look out at this chart going back to the beginning of 2022, we see a couple of really interesting things. One is value and technology after 2 years basically ended up at almost the same point, which if you think about technology being up almost 67% in 2023, that means that technology really took a beating in 2022. And you can see that, the green line being the technology side. So in order to get to the point where you can be, let's call it slightly positive over and above the value at the end of those 2 years, you had to live through, let's call it minus 35% in this technology index versus value, which was sort of in that kind of minus 15, minus 20. So for me, Marshall, and I think for most of our clients, that experience of not watching their investments fall 30% in a year like 2022 is really valuable, right? It was a really frustrating period the last couple of years up until the last quarter of 2023, but it was not a catastrophic year.
Yeah, I agree.
Here we've got value versus growth outside of the U.S., so just an indicator of what this looks like in other countries. And you can see in blue here, the line on top is value, and underneath that is growth. So outside of the U.S., value actually did better than growth. So this conversation of technology being the leaders is really a U.S. story. And I think, Marshall, it's because you've got these large global Goliaths that are being backed by AI, and potentially in another realm where ChatGPT was not announced and released the way it was, maybe the outcomes for the technology index are dramatically different. But last year we got a nice lift from technology, and we were happy that we weren't predicting the downfall of technology after that significantly negative 2022 year, but also not predicting that technology is going to run away with things moving forward. I think, Marshall, this highlights one of the things that is really counterintuitive in markets, which is as things become more expensive, our expected return into the future actually goes down. And as things become less expensive or cheaper, our expected return into the future goes up. And that's counterintuitive, I think, for lots of folks.
Yeah, it is true. We have to think always about that word expected, though, right? Because in 2023 would have had maybe a different expectation around certain technology companies, but they dramatically outperformed expectations.
Yeah. This slide now, looking at large versus small companies outside the U.S., and we can see that returns were very similar in 2023, and they sort of tracked through 2022 and 2023, with large slightly underperforming in 2023 and outperforming in 2022. Marshall, this I think is a story that makes a lot of sense. In 2022 there was lots of concern about the rising interest rates in the economy and inflation and what would happen to companies. And large companies tend to be a little less risky in that type of an environment, and showed a bit of outperformance that way. Would you agree, or would you disagree?
Yeah. No, the other thing, when interest rates are coming up, and these smaller companies are going to be more impacted by their cost of capital, their lending rates are going up, and that can have some definite impacts on their profitability in the short term. So something to keep in mind. So what will happen, if rates stay really, really high? How will that impact smaller companies versus larger? That'll be seen in the future.
And then last but not least, for the 2-year period, Canada versus the U.S. and countries outside of the U.S. here. So despite a very significantly different experience in 2022 between Canada and other countries, where we had concerns about inflation and commodities, and Canada being a commodity oriented economy, kind of reaping the benefit of that, for lack of a better way to put it. We saw the gap close in 2023 as concerns around inflation and rising interest rates decreased towards the end of the year.
Yeah.
And so we sort of got to the same place no matter what we held, but the experience was very different if we weren't diversified across
diversification
markets.
In 2023. Diversification was a huge help for us, right, Cary?
Yeah, especially in 2022, right? As things were falling, and then I think there's always a bit of FOMO when you see a very small portion of the market rocket the way the Magnificent Seven did. But we have to put that into context, because things in 2022 were not very fun if you were a holder of those companies.
Agreed.
Yeah. Okay, Marshall, let's shift to interest rates and bonds and really dig into what's happened here, because I think this is probably the biggest story. Even though Magnificent Seven and those types of outsized recoveries really grab headlines, I think bonds and interest rates are the thing that really were, looking back, we're going to look at sort of the 2020 to 2023 period and what happened with bonds and interest rates as a real turning point.
Mm-hmm.
Do you want to touch on, there's lots here. Do you want to touch on what the different lines are telling us here over the last 2 years for Canadian bonds?
Yeah, let me just focus on the red line and the yellow line. If we're looking at short-term bonds and looking at long-term bonds in the Canadian marketplace, when interest rates are rising, that has a negative short-term impact on the prices of bonds that we own. In that, for somebody to own a new bond after interest rates are going up, they're going to get a higher rate of return. So why go and buy the old bond when you can get a new bond? So the markets have to change the prices of existing bonds to make the new bond holder indifferent. The fall that we saw in the long-term bond market was really, really dramatic. And our bond portfolios at North Road are not heavily exposed to long-term bonds. And that was done on purpose, in that we did not want to take the risks of interest rates rising and our portfolios getting really, really hurt. So in terms of what we believe the fixed income portfolio needs to do in its kind of diversification role, we want it to be, lower risks. We expect lower returns, and we definitely want it to be an offset to the risks that we're taking in real assets and in equity markets. So looking out to 2024, the rate of return that we're receiving from what we call our Cary on the bond is much higher than we had in 2022 and the beginnings of 2023. And again, that's because interest rates have come up. Anything to add on that, Cary?
No, I think, again, zooming out and looking at the 2-year period, and you touched on this, it looks in 2023 like long-term bonds are the place you want to be, right? They had the highest return in the bond market, really lifting quite a lot in the last quarter of the year because concerns about rising interest rates were diminished. And so you really see this bounce back, but you have to zoom back out and just see how dramatic the fall was. Over, let's call it 20-ish months, you're minus 25% in what is supposed to be your quote unquote safe assets in your portfolio. And that's really challenging. And thankfully, we had focused more on short-term bonds and on the profile of short-term bonds, recognizing that interest rates were very low. And it benefited us in 2022 when this was happening. It didn't always, right, Marshall? This wasn't us predicting the future. This was us just saying, hey, we want bonds to be a safe place in portfolios, and we recognize that bonds have interest rate risk. And as a result, we want to minimize that. We did not see a big rebound towards the end of the year, a little bit, but we didn't get to take advantage of that. And that's okay. We're fine with that. That's part of the strategy.
Absolutely.
Let's talk about REITs, because they've also been hurt quite badly by, I think, a couple of different things, but I think for the most part, Marshall, we'll focus on interest rates, but because this really shows the REIT index across Canada and the U.S. on the right side, or pardon me, global on the right side here for 2023, but also in the line chart going back to the beginning of 2022. And because it's a REIT index, it is broadly diversified, at least as available REITs in the public markets are diversified. And you can see, I mean, it's been a really, really challenging period until the last quarter of 2023, down, let's call it 35% in the REIT index. And then this big bounce back at the end of the quarter as concerns over interest rate increases have diminished. Marshall, anything you want to touch on REITs around what's happened in the last couple of years?
Well, there's no question that REIT, the complex of a REIT, is using debt to finance the goings-ons of the business, and interest rate increases are going to have impacts on their profitability. But I guess in our conversations, we hear a lot about kind of the death of downtowns, and is our renters going to be taking up commercial real estate like they have in the past? And it's not a guarantee that we can walk away from the buildings that might have higher occupancy levels and say that those businesses will never be profitable again. I believe that things can happen that can take these buildings and dramatically change them. So REITs, it's not all going to be commercial. There's industrial, and there's hotels, and there's a variety of different other things. But there's no guarantee that post COVID that the profitability of REITs are going to be forever diminished. And we saw that in the marketplace at the back end of 2023 with a pretty dramatic increase in their returns.
Yeah, and Marshall, this is another sign. I've mentioned this lots in the last 3 or 4 years, but I'm so thankful of the way that we have decided to manage money, where we really take this non-predictive approach. Because if you were looking at REITs for the very many years prior to this, couple years on the screen, REITs were an absolute monster outperformer compared to lots of asset classes. They were a great place to be for lots and lots of folks, and for a long time period. And so then they got really hurt as the economic scenario changed. So recognizing that REITs provide some diversification is something that we've done and we agree with, but at the same time, we're not putting big bets on any one area like this, because you just don't know what the future is going to hold.
Yeah, exactly right.
Marshall, lots of questions from clients on housing and interest rates and how that's affecting housing. Lots of folks talking about, should I be chatting with my kids and grandkids about this stuff? Do I need to help out? How do I look at housing and the future of housing for my family? And I thought this was a great chart showing a couple of different things here, but the line chart at the bottom, I think, is something that lots of our clients are going to find really interesting. I've heard over the last couple of years a lot of stories from our clients about remembering back to their first house and 12% mortgage, 16% mortgage, these really high mortgage rates, and wondering how folks are affording housing now, but also remembering that interest rates in their mind and their experience were much, much higher. But when we look at what's happened in housing prices and compare that against incomes and against borrowing rates, it becomes really dramatic just how challenging the housing market is in lots of places in Canada. So you can see on the line chart that housing affordability is in its most challenging period, going back to the 90s for sure. And then you look at the share of income of a household in many cities, and I mean these numbers are pretty scary, to be frank, as far as regular kind of median incomes.
Yeah, home ownership for many Canadians is out of the question. That's unfortunate. Edmonton has a much different story, especially comparing to cities like Toronto and Vancouver. But still, those numbers are rising, and it's having some big impacts on our country.
Yeah, for sure. And I think as a result, we're having lots of conversations, right? That first home savings account changes the conversation a little bit. It's something we need to be thinking about, and taking a longer term perspective on what I would call multi-generational wealth, and how do we help folks that way. And even I think, Marshall, for you and I, one of our things that we're really proud of is how much we've been able to help clients with their charitable giving and giving in a way that's really tax efficient and gets more money into charities' hands. And this is a housing story here, but affordability, I think, is across the board is a big conversation right now, whether that's food or housing. So,
Yeah. Yeah.
I'm happy with some of those conversations and how we're helping out.
Yeah. I think I'd like to add something else in the terms of home ownership doesn't need to be the goal for everyone all the time. And I think and maybe it's media, maybe it's society that says, you're a failure if you don't own a home. And I think that's not true. I think you can have a great long-term financial plan and a financial picture if you rent a home and can provide flexibility, could potentially be cheaper than owning a home in when you measure all the different costs. So something just to add, and if somebody's looking at this chart and thinking that they'll never own a home, well, maybe that's not such a bad thing for the right person.
Yeah, good point. Okay, Marshall, let's take a few minutes and look forward. Let's talk about a couple of the challenges that we see coming up that folks will probably hear about in the news, but also some of the things we're really optimistic about. One of the things that I mentioned earlier, the contrary nature of rising prices and future expected returns. On the bond side, as much as bonds got really hurt, especially long-term bonds, as interest rates rose over the last couple of years, it also means that bonds that we hold now, we're holding them at higher yields. And so this is I would think as investors, and this is a good news story. Wouldn't you agree, Marshall?
Yeah, absolutely. It sure is nice getting paid for the money that we're lending to corporations and governments, and it really, really helps out on the income side for seniors.
Yeah. Marshall, I'm going to try and explain a couple concepts with the numbers that we have here. And you jump in if you think I've gotten this wrong.
Good luck.
Because there's lots of sort of complexity in the way we talk about jargon when it comes to bonds. But so where I've got the red dot, weighted average yield to maturity, this is the yield that for intensive purposes, all intents and purposes, we can sort of say is if we hold this particular ETF that we're highlighting on the screen is our expected return moving forward. It's not perfect, prices move, but this is sort of what we would expect. In particular, if we hold it over the maturity or duration period. So if we continue to hold it and all else equal, prices stay exactly the same for 2.5 to 3 years, we would sort of expect a 4.51%. Okay, I'm putting in lots of assumptions and I'm shaving off the edges on the complexity here. But Marshall, how did I do?
That's good. In terms of us receiving that 4.51%, I would say that we would then see interest rates not changing through the next 2 to 3 years. If they don't change, then we should see a 4.5% return.
Yeah. If interest rates get cut, we might expect more because prices will go up. If interest rates go up, we might expect less because prices would come down.
That's correct.
Okay. I think the other thing that's interesting here, Marshall, is lots of folks will have heard of a coupon on bonds, which in this case, because bonds were issued with lower interest rates in the recent past, those interest rates are a little more reflected in the coupon compared to the yield. So we can actually, from a tax perspective, really start to get more attractive after-tax yields on our bonds as a result of what's happened in the recent past around interest rates. So there's some good news here for us, for folks who are really interested in managing tax while still getting bond exposure. There's some opportunity for us to help manage that a little bit.
That's good.
Anything you want to add there, Marshall?
No, that's good.
Okay. Let's talk about elections. 2024 is going to be a big election year, not just because it's a U.S. presidential election. Marshall, I was listening to some international news the other day, and they started rattling off the number of countries that have elections, starting with Taiwan, I think, last week. And it's a big number. And so I think that this presidential election in 2024 is going to be challenging in the news, no matter what. But now we've got the rise of very easy to use AI tools that I think are going to be a big part of that news cycle. So I wanted to highlight for folks that this is coming. It's going to be in the news. And sometimes we get folks who get a bit anxious about negative news and how it's going to affect investments. So Marshall, we've got 2 slides here on presidential elections. Do you want to take this first one, or do you want me to take a stab at it?
Yeah, our friends at Dimensional Fund Advisors have put this together, and it helps speak to the fact that despite whoever's in the White House, it doesn't have a direct relationship on the returns of the capital markets. If it's a Republican president or a Democratic president, there's no correlation. And we might not like who's the president, but we could still get a good return, and we might love who the president is, and maybe just get the opposite impact on the returns that we'd hope for.
Yeah, I think that's a great explanation. So, a reminder that economies are complex, markets are complex, tough to predict. We should kind of, for lack of a better way to put it, hold our nose and accept that if we want stock market like returns in the future, we need to hold stock markets, whether it's a Republican or a Democrat in the presidential chair, or whether we like the person who's in the presidential chair. We got to hold on. And I like this chart in particular because it looks at, the month that a Republican won or the month that a Democrat won versus all the other monthly returns. And there's just no pattern.
Yeah, that's right.
There's no pattern here. And Marshall, you and I got to, and our team back many, many years ago when Donald Trump was first elected, got to eat some humble pie, because when that first happened, we were chatting about how we thought if he won, prior to that, if he won, that it was really going to cause haywire. Things are going to go haywire and create some havoc and some volatility in markets, and we should really be cautious. And we were right for about 2 hours overnight, I think, as futures markets fell, and then the next day went back up and just seemed to keep going up under his first mandate, right? So these things are complex and hard to predict, and we're better off not predicting. All right. The other thing that we're hearing quite a bit about in Canada, in particular, Marshall, is potential for recession. And so I thought we should touch on recessions and how those play out in markets.
Absolutely. This is something that comes up a lot in our world as advisors. We're getting different reports about is the Canadian economy expanding? Is it contracting? Is the global economy expanding or contracting? And can we take that information that we get in the Globe and Mail or the CBC news, and can we make an informed investment decision and change our investment portfolio with it? What we know is this: the markets are forward looking. Generally speaking, they've already priced in potentially the reality of an expanding or contracting economy, and when it's announced, it's kind of already baked into the pudding, right? We're not going to be able to get that announcement to get out of markets if there's a recession, and then wait for the announcement to come in to get back into the markets. If we would have done that in this example in particular, we would have missed out on a huge return if we would have waited for the end of the announcement or the end of the recession announcement to happen.
Yeah. Marshall, anecdotally, I often tell clients that the best time to invest is when it feels the worst. And historically, that seems pretty accurate. If you look at this example, when it felt really, really bad, and we were in the middle of falling markets and a recession has just been announced, that's the time when you actually want to be owning markets. But it's hard. I tell the story a lot about March 2020 in the COVID pandemic, when markets were going haywire and things were nothing but bad news day after day after day, that prior to that, I had a line of credit. I was going to invest at the next -30 market. And I can tell you 100% I did not invest a single penny from that line of credit when markets were falling 10% a day.
Yeah.
Right?
It's tough to invest. And is there ever a
hard.
time when we're bringing in a new family to the practice where we feel great about the next few quarters of returns? Like, it's never that way for me. I always think, there's dark clouds on the horizon, but you and I know that we're not investing for 6 months. We're investing for 6 years, 16 years, and 26 years. So that helps us make better decisions with capital.
Yeah, agreed. Let's talk about a story that folks may or may not have heard, Marshall. I don't know that this came out in the media too much, but I've got a special place in my heart from living in Japan for a couple of years, and so what was announced towards the end of 2023 was that the Japanese index, the stock market index, was getting very close to all-time highs for the first time since 1989. So when the when markets in Japan were rocking in the 80s and then fell quite dramatically. And so I wanted to highlight this for a couple of reasons, Marshall. One is it's a good news story, I think, that the economy in Japan has turned around. A lot of this has been because of inflation finally showing up. So we talked a lot about in the last couple of years about how challenging inflation can be, but deflation is really challenging. And if it sticks around as long as it did in Japan, a real problem. And so we've seen markets in Japan come back around. I also think it really does highlight, Marshall, that we just can't predict the future. If you were in the 80s, Japan was the place to be invested. And then it wasn't for decades. And so this non-predictive, massively diversified approach, I think, as I said earlier, I'm very thankful for.
Absolutely.
So let's talk a little bit about how we're continuing that process, Marshall, and how we're adding diversification to portfolios now that North Road, you and Jaw and I and Richard have had a chance to review asset classes and see what else is available.
Yeah, so this slide just speaks to how we want to take a massive diversification plan into every portfolio that we're managing, starting at the fixed income to equity splits. We want to make sure that we have the right level there. Stage 2, we want to make sure that geography is being covered. We don't want a full Canadian portfolio. We want American stocks, non-North American businesses, and emerging market businesses in the portfolio. We want to include real assets in the portfolio, and that's going to be inclusive of things like private farmland and timber and infrastructure and investments, as well as publicly traded real estate investment trusts, as we spoke about earlier in the webinar. Then we're going to be making sure that our exposures to the factors or the historical where the components of returns have been seen to be expressed in a more positive way. We want our portfolios to have exposure to size, value, and profitability across all the geographies. And then some updates in our portfolio. Not meant to give a lot of detail now, but we've added a factor of momentum to our global equity portfolio, as well as adding alternatives in a small but an important way to the portfolio to further diversify. And all this is done, Cary, in a non-predictive way. It's done in a very mechanical way. And as markets are changing at different levels, we're going to be rebalancing portfolios right back to original targets.
Yeah, I'm really optimistic and excited about this, Marshall. You and I have been talking about this stage 5 and stage 6 things now for, it seems like 4 or 5 years. And I feel like over the last kind of 6 months, our team has really found options that work well for our clients in particular, and that provide diversification that's going to make their lives feel a little smoother as markets go up and down. So I'm excited to continue to talk about these things with clients over the next coming months and quarters. I'd like to just let clients know that we are more than happy to hear from them if they need us to take what we talked about today and adapt it to their particular portfolio or something that's changing in their lives. Please don't hesitate to reach out to us and let us know that you want to have a phone call or a Teams meeting or come in and see us. We're really excited to talk to you, and we are making our way through the TFSAs and the RSPs and the FHSAs and all the new things that happen at the beginning of the year, and statements and all those things that are keeping the team busy. But if you want to take what you heard today and get a very particular personal adaptation of that, please reach out to us. And if you liked what you saw today, let us know. We'd love to hear from you on that. And if you didn't and we missed something, let us know. We love to know and we can get better. Yeah. What did I miss, Marshall?
That's got it, Cary. Thanks for your efforts, and appreciate the time. And everybody, thanks for joining us for this 2023 year in review.
Thanks.